Hold on tight. A top market strategist says a stomach-churning pullback is underway, but says resist the urge to sell. Let's bring in Tony Dwyer, the chief market strategist at Canaccord Genuity. Tony, welcome.
Thanks for having me, Mel.
What kind of pullback are we talking about?
Almost exactly like the May pullback. You know, you get, it's not that, first of all, think of the term from Marty Zweig, don't fight the Fed. Why isn't it follow the Fed? Because human nature is always there's something wrong when the Fed is cutting rates, so you should fight them. So that, you know, it's don't fight the Fed, but that was so it's not Fed related, it's not fundamentally related. It really comes down to, we've had a heck of a move off of the May low, and things got overbought a little bit too enthusiastic, exactly where we were on April 30th when we came on the show and made the call. And this was from last week.
So you're saying like a 5% or so pullback, and at that point you should buy that dip.
But
if you're fully invested here, don't do anything.
And I've said it so many times on the show that it's almost boring. Until credit shuts down, you want to buy every dip. That's the fact of being at a new high. So I think it's a really important point. As long as credit is open, which it is, you want to buy the dip.
As long as there's a race to the bottom in rates, Tony, I mean, don't fight the Fed, does that still hold water? I mean, we're looking at an ECB meeting this week. There's talk about them doing a preemptive cut in order to offset what the fallout could be on the euro. So if all this is happening, does don't fight the Fed still hold water? There's
been a shift, a major shift. I've even almost called it a generational shift in Fed thinking. You've got unemployment at the lowest level in history, or one of the lowest levels in history. They raised rates because they're worried about the impact on overall inflation because of labor inflation, right? And you got 1.6% core PCE, which for the viewers, that's core inflation. You got to be pretty scared. If you got unemployment at the lowest level it's been at, solid gains in average hourly earnings, and the best you got is 1.6%. So what they've been saying in the last month is very important that Steve Leisman picked up on, and not everybody picked up on, in my opinion. It's not focused on enough. They said they don't want to be Japan and now Europe. They're telling you that Japan and Europe are in this negative rate environment that they can't get out of. He told you he doesn't want to be there. That tells me they're going to be a lot more aggressive. And remember, we've been looking for a Fed rate cut in the summertime since December. This is going to get aggressive, in our opinion. Not because the economy is tanking, but if all of a sudden inflation expectations go too low and you start to spiral down in interest rates, you got a problem. So they're going to try and beat that before it happens, and they may already be too late.
So, Tony, if the only thing that we have to worry about is credit shutting down, tell the folks at home, what do we look for? What does that look like? What does credit shutting down look like?
It's a great question. It's corporate credit spreads. So you take a look at high-yield debt, the Barclays high-yield debt relative to treasuries. There's something that anybody can get. Go to the Chicago Fed website. On there, you can find the National Financial Conditions Subindices. There are 3 subindices that measure 105 indicators of credit stress in banking, shadow banking, and the financial markets. I wake up every day trying to figure out how I'm wrong. So it's not like I come on here and try and figure out, you know, how to be bullish. I look to see if the story's got holes in it. And the only times I've seen sustainable holes in buying a dip is when the credit stress indicators are going bonkers. And in the meantime, 2 of the 3 indices are at a cycle low or right next to it. So until you get that credit, look at 2018, look at 2015, 16, look at 2011. The way that I kind of categorize the economy is it's almost like bumper bowling. You know, bumper bowling with your kids?
No.
You can't.
Oh, yeah.
Yes, you do.
You can't
get in the gutter, right?
I've bowled my life.
Right. So bumper bowling
like
is you
everybody
can't throw the
medal.
ball down the lane and get in the gutter.
Yeah.
So what economically is, there's too much debt. You cannot fix debt with exponentially more debt. This is not going to end well. But when you get up to 3%, you're hitting the left bumper and you come back in. Slows the economy down. You get back to 2%. Wow, we get to refi that debt we did above 2.5%, picks the economy up. Why could you have a reacceleration next year? Because rates went from 3.25% to 2%. Right. There's a massive refi boom going on that's going to end up with the whole story in the first half was it's going to slow down, and that's the bull story. Now it's the opposite.
Tony, good to see you. Thank you. Tony
Thank
Dwyer,
you for letting me rant, Mel.
Putting
metaphor.
aside a discussion of bumper bowling, because I know that is going to spark some controversy here on this desk.
I was going to actually talk about it. I think we should go.
Tim.
We should go bumper bowl. Look, Tony's talking about potential asset bubbles and leveraged loans in U.S. Treasuries and U.S. corporate bonds. You can't disagree with that. Correlation between stocks and bonds right now is almost 1. That concerns me.